Stop what you're doing immediately. Put the sandwich down. Yes, even if you just took a bite. If you have to, spit it out. This matters more than lunch. Tell your boss you'll be unavailable for a few minutes. Tell your wife the trash can wait. If you're driving, pull over. If you're in the shower, step out. Are we on the same page? Good? Ladies and gentlemen, it's Tuesday, January 13th, Downselling Archelieu. And what I'm about to tell you is going to make your blood boil. Yesterday, Monday, January 12th, we watched silver smash through $85 an ounce. We saw the Shanghai Futures Exchange trading near $93. We celebrated. We talked about the end of arbitrage. We talked about the paper market falling apart and the physical market taking control. We talked about the system breaking down in real time. Then, last night, while you were asleep, while you were scrolling TikTok, while you were binge-watching some Netflix series you won't remember in a few days, the empire struck back. The Chicago Mercantile Exchange, the CME, the organization that controls the COMEX futures market and sets the rules for paper silver trading, issued a notice, a margin advisory, and inside that notice, they announced that the changes would take effect immediately. Not next week, not next month. Today, Tuesday, January 13th, they completely altered the margin structure for silver futures. And they did it in a way that was carefully, deliberately, and precisely engineered to crush retail traders, to force out small players, to trigger liquidations, and to protect major banks that are sitting on massive short positions and bleeding billions of dollars. This is not a conspiracy theory. This is not guesswork. This is documented. The numbers are there. The math checks out. History backs it up. And I'm about to explain exactly what they did, why they did it, and what it means for your money. But before we go any further, you need to understand one thing. What you're about to hear will sound unbelievable. It will sound like the kind of market manipulation people laugh about but never think actually happens. It will feel like something straight out of a movie, where the villains control the system and rig the game. But it's real. It happened last night. It's happening right now as you're watching this. And if you don't understand it, if you panic and sell the moment you see a red candle on your screen, you could miss the largest wealth transfer of your lifetime. So stay focused. Strap in. And let me show you exactly how the game is rigged. Here's what happened. The CME released a margin notice late yesterday evening, Monday, January 12th. The notice explained that margin requirements for silver futures contracts were being changed. If you've never traded futures before, let me break down what margin actually means. When you enter a futures contract, you don't pay the full value up front. Instead, you put down a portion of the total value as collateral. That portion is known as the margin. Think of it like a security deposit. One silver futures contract on the COMEX represents 5,000 ounces of silver. At a price of $85 per ounce, that single contract controls $425,000 worth of silver. But you don't need $425,000 to hold that position. Under the previous rules, the required margin was roughly $32. Wubai. That's the power of futures trading leverage. It allows you to control a large position with relatively little capital. With $32, $500 posted against a $425,000 contract. You're using about 3-to-1 leverage. Every dollar you put up gives you control over $13 worth of silver. This is how retail traders, people without billions in capital, are able to participate in these markets. We rely on leverage to compete above our weight class. And the banks despise that. Because when retail traders use leverage to go long silver, when demand builds and delivery is requested, it directly threatens their short positions. It puts the entire paper-based system at risk. So what did the CME do? They rewrote the rules to shrink our leverage and push us out. Here's the exact change they implemented. Under the old structure, the margin was a fixed dollar amount, $32, 6 cents per contract. Whether silver traded at $50, 85 yuan, or $100, didn't matter, the margin stayed the same. Under the new rules, which took effect today, margin is now calculated as a percentage of the contract's notional value, specifically 9%. What does that mean in simple terms? The margin is no longer fixed. It now rises as the value of the contract rises. At OTFM Silver, one contract is worth $425,000. 9% of that equals $38. Down by Wusher. So the required margin just jumped from $32. $538 to $38. Down by Wusher. That's an increase of $5. $750 per contract, roughly a 7% hike overnight, with no warning, right in the middle of a historic rally. Now, you might be thinking, okay, an 18% margin increase is painful. but it's manageable. That assumption is wrong. Here's why this is devastating for retail traders. If you were already using maximum leverage, if every dollar of available capital was deployed across multiple contracts, you woke up to a margin call this morning. A margin call means your account no longer has enough funds to satisfy the new margin requirements. Your broker sends you an alert, and you're left with only two options. Option 1, immediately add more cash to your account to meet the higher requirement. Option 2, close your position. Sell and exit the trade. The reality is that most retail traders don't have an extra $50,000 or $100,000 sitting in their bank account, ready to be transferred on a moment's notice, so they have no choice but to sell. They're forced to liquidate their positions at whatever the market price happens to be at that moment. And when thousands of retail traders are pushed into selling all at once, what happens to the price? It collapses. It drops hard, not because the fundamentals suddenly changed, not because silver magically appeared in vaults, and not because industrial demand disappeared, but because the exchange altered the rules to trigger forced liquidation. That is market manipulation. Plain and simple. This is the CME, along with the big banks, changing the rules in the middle of the game to flush out retail investors who dared to take the opposite side of their trades. And this is not new. They've done this before. Let me give you the historical context, because this pattern repeats itself again and again. In January 2011, silver was in the middle of a powerful rally. Prices had surged from $18 an ounce to nearly $30 in just a few months. Retail participation was exploding. Momentum was accelerating. The squeeze was underway. So, what did the CME do? They raised margin requirements not once, not twice, but 5 times in just 9 days. Let that sink in. 5 margin hikes in 9 days. Margins were increased from $6,000 per contract to $21,000 per contract. That's a 350% increase in barely over a week. And what was the result? Prices fell sharply, dropping from $30 to $26 in a matter of days. Thousands of retail traders were wiped out. The rally stalled. Many people believed it was finished. But it wasn't, because the underlying fundamentals never changed. Silver regrouped and continued climbing. By April 2011, it was nearing $50 an ounce. And once again, the CME stepped in with more margin increases. Then came the final blow. On Sunday night, April 24th, 2011, a date that remains infamous in the silver community, they delivered the knockout punch. Margins were raised aggressively while markets were closed, leaving traders unable to react. When trading resumed on Monday morning, prices gapped lower, collapsing from $50 to $42 in a single session. Then the decline continued, $35, 35美元, and eventually all the way down to $26 by the end of September. That episode became known as Silver Sunday, and it had nothing to do with fundamentals. It wasn't driven by supply or demand. It was the direct result of rule changes engineered to crush retail investors and shield the banks. Now, fast forward to 2026. History is repeating itself. Silver has just broken above $85. Shanghai is trading near $93. The squeeze is underway. The system is cracking. And how does the CME respond? By raising margins, by switching from a fixed dollar requirement to a percentage of notional value, by forcing liquidations, by manufacturing a sell-off. Same playbook, same tactics. Same objective, protect the banks and wipe out retail traders. But here's the key point. It didn't work in 2011, at least not over the long term. Yes, they drove the price down from $50 to $26, but silver didn't stay there. Over the following decade, the fundamentals reasserted themselves. In 2020 and 2021, silver launched into another major rally. And now, in 2026, we are standing at the very beginning of what will be the largest silver bull market in history. And no amount of margin manipulation is going to stop it. Because this time truly is different. This time the shortage is real. This time industrial demand is exploding. This time China has restricted exports. This time the Shanghai premium is $14 and still widening. This time the physical market has fully decoupled from the paper market. And physical reality cannot be manipulated. You can manipulate paper contracts. You can adjust margin requirements. You can force traders out of futures positions, but you cannot force solar panel manufacturers to stop consuming silver. You cannot make Tesla stop producing electric vehicles. You cannot make the Chinese military stop building missiles. And you cannot print physical silver out of thin air the way you can print fiat currency. Whenever gold rises more than 38% within a single calendar year, a severe recession follows within the next 12 months. Every time. No exceptions. This has occurred 3 times in modern history. 1973. 1980, and 2008. Let me walk you through each case. In 1973, gold surged more than 40%, climbing from $63 an ounce to $97. The following year, in 1974, the United States fell into one of the worst recessions since the Great Depression. Unemployment jumped, GDP contracted, equity markets collapsed, inflation exploded into double digits. It was an economic disaster. In 1980, gold rose more than 100%, moving from $512 to $850. The year after, the U.S. entered another brutal recession. The Federal Reserve was forced to push interest rates to nearly 20% to crush inflation. Unemployment climbed to almost 11%. The damage was severe. In 2008, gold increased more than 30%, rising from $833 to $1,087. The recession had already begun and then accelerated into 2009. The global financial crisis unfolded. Lehman Brothers collapsed. Stock markets lost roughly half their value. It became the worst economic collapse since the 1,930 seconds. The pattern is unmistakable. When gold rises more than 38% in a year, it serves as a warning signal. It's the market shouting that something is fundamentally broken in the financial system. Capital begins fleeing paper assets and moving into hard assets because confidence in the system is evaporating. And now, in 2025, gold rose more than 40%, climbing from around $3,000 to over $4. Buy. The signal has been triggered. The alarm is sounding, and according to Bradshaw, a recession is now inevitable. Bradshaw believes the coming cycle will closely resemble what happened in 2008. First comes a short-term liquidity crunch, a moment when everything sells off at once. Stocks, bonds, commodities. Crypto, everything falls because people need cash. In 2008, gold and silver initially sold off. Not because they were bad assets, but because investors were forced to liquidate everything to raise cash. Gold dropped from roughly $1,000 to $730 in just weeks. Silver collapsed from $21 to $8. But then, once the Federal Reserve stepped in, once trillions of dollars were printed, banks were rescued, and liquidity flooded the system, gold and silver exploded higher. Gold surged from $730 to $1. $900 over the next 3 years. Silver rocketed from $8 to $49. The true bull market didn't begin until after the crash. The crash was the purge, the final washout of weak hands before the real move higher. And Bradshaw believes we're about to witness that same sequence again. A short-term liquidity shock. Broad-based panic selling, followed by massive money printing and then gold and silver going vertical. And this is where things get truly explosive. Bradshaw has laid out clear price targets for this cycle. He is forecasting $9,000 per ounce for gold and $375 per ounce for silver by 2028. Let that sink in for a moment. $375 per ounce for silver. Not $100. Not $150. 375 yuan. That's more than 4 times today's price, representing roughly a 440% gain from $85. And these numbers are not coming out of nowhere. They are grounded in historical cycles. Massive monetary expansion, unsustainable debt levels, and surging industrial demand. He's analyzing the same data sets central banks rely on. And his conclusion is simple. The system is heading toward a breaking point. The dollar is set to lose significant purchasing power, and hard assets are positioned to surge dramatically. Now let me connect all the dots. Because everything you've heard so far fits together. The CME just raised margin requirements. Why now? Why do this in the middle of a powerful rally? Why, right after silver broke $85 and Shanghai started trading near $93? Because they know what's coming. They know Bradshaw's analysis is correct. They know the 38% signal has already been triggered, and they know a recession is on the way. They also know that when the recession hits, when the Federal Reserve is forced to print another $5 trillion, or maybe $10 trillion, to prop up the system, gold and silver are going to go parabolic. And if retail traders are still positioned when that happens, the banks are in serious trouble, because those banks are massively short silver. For years, they've been flooding the market with paper silver to suppress prices and profit from that suppression. But if silver runs to $375, those short positions turn into catastrophic losses, losses large enough to threaten major financial institutions. So what's their move? They change the rules now, before the real move begins. They hike margins to force retail traders out. They manufacture fear. They trigger panic. They engineer a pullback. They flush out weak hands so that when the true rally starts, when silver moves from $85 to $150, then to $250, and eventually to $375, retail investors are no longer in the trade. We get liquidated. We get scared out. We sell near the bottom. And the banks get the opportunity to cover their shorts at manageable prices before the explosion. This is financial warfare, and we are the target. But here's the upside. They're revealing their fear. By changing the rules mid-rally, they're admitting they're losing control. They're admitting the fundamentals are stacked against them. And the only tool they have left is to rig the game. And when your opponent is that desperate when they have to cheat just to survive, that is not the moment to fold. That's the moment to hold. That's the moment to stand your ground. That's the moment to look them straight in the eye and say, I'm not selling. Breeder. The Reser. Now, let me show you the growing disconnect between the paper market and the physical market, because this is where the deception becomes impossible to ignore. In the paper market, the CME has just raised margin requirements. Leverage has been reduced. Forced selling is underway. Prices are under pressure. Traders are panicking. But in the physical market, nothing has changed. Shanghai is still trading at $93 and $8 premium over the COMEX spot price. Dealers across the United States are still charging premiums of $8 to $10 for physical coins and bars. Some are asking as much as $15 over spot. Mints are still reporting delays of 8 weeks or longer on new orders. The physical shortage is still real. Vaults are still thin. Industrial demand continues to surge. And the Chinese export licensing system that went into effect on January 1st is still firmly in place. None of the underlying fundamentals have changed. The only thing that changed is the rule book of the paper casino. And this is the key point you must understand. The CME could raise margins to 100% if it wanted to. They could make futures trading so expensive that almost no one could participate. They could effectively shut down the paper market altogether. But none of that creates a single ounce of physical silver. It doesn't open a new mine in Mexico. It doesn't convince China to resume exports. It doesn't reduce demand from Tesla, Apple, or solar panel manufacturers. All it does is temporarily suppress the paper price while the physical shortage continues to intensify. Eventually, the paper price must converge with physical reality. You can't deliver paper. You can't build a smartphone with a futures contract. You can't manufacture a Patriot missile using an ETF share. At some point, real metal is required, and when industrial buyers stand for delivery, when they demand physical bars and the COMEX can't supply them, the paper market collapses, and price moves to wherever the physical market dictates. By Shanghai's pricing, that level is already $93. And according to Tom Bradshaw's analysis, it ultimately reaches $375. So here's what the CME is trying to do. They want to engineer a sell-off right now, today, this morning, to scare you. They want you to see red candles on your chart. They want silver to drop from $85 to $82. Or FIRS. Or Ode O Hellfjords. They want panic. They want you thinking. The rally is over. The bubble burst. I'd better sell before this goes back to $50. Matter, monase, different. Monase, matter for, monase. They want you to forget Shanghai at $93. Forget the physical premiums. Forget the industrial shortage. Forget Tom Bradshaw's $375 target. They want you focused on a $5 pullback so you panic sell your position so they can buy it cheaply. Cover their shorts at $80 instead of $150. And survive the squeeze that's coming. This is a last-ditch move by a broken system. This is the death rattle of a rigged casino that knows its game is nearly over. And if you fall for this, if you sell your physical silver just because the paper price drops a few dollars, you will regret it for the rest of your life. So let me be absolutely clear about what matters right now. If you own physical silver coins, bars, or rounds stored in a safe or allocated storage, do not sell. Don't even consider it. The paper market is lying to you. The physical market is telling the truth. And the truth is simple silver is scarce. Demand is surging. The system is cracking. And the price is headed toward $375. If you hold silver futures and you received a margin call this morning, you now face a choice. If you have additional capital available, if you can add funds to meet the new margin requirements, then do so and hold your position. But if you're fully deployed and don't have extra capital, then close the futures position and use the proceeds to buy physical silver. Exit the paper market, where the rules can be changed overnight. Move into the physical market, where they can't touch your metal. Physical silver is the lifeboat. Paper silver is the Titanic. Choose carefully. If you don't own any silver yet and you've been waiting for the perfect moment, this is it. Don't wait for $70. Don't wait for mainstream media to tell you it's safe. Don't wait for a financial advisor who likely doesn't own any silver himself to give you approval. Buy physical silver now. Today, pay the premium, accept the delivery delays. Yes, you may pay $93 or $95 all in while the spot price says $85, but 6 months from now, when spot is $150 and dealers have no inventory, you'll wish you paid $95 today. This is not financial advice. I'm not your advisor, and I'm not telling you what to do with your money. I'm simply telling you what I see. And what I see is a paper market that's breaking down, a physical market flashing shortage, a Federal Reserve boxed into a corner, a recession signal with a flawless historical record, a respected macro strategist calling for $375 silver, and a futures exchange so desperate to stop the rally that it's rewriting the rules mid-game. Every signal is pointing in the same direction. Every piece of evidence is delivering the same message. The only real question is whether you're going to pay attention or let fear and manipulation scare you out of what could be the most important trade of your lifetime. The decision is yours, but don't take too long. The window is closing. The margins have been crushed. The rug pull is real. But so is the physical shortage. So is the recession signal. So is the Shanghai premium. And so is the $375 silver target. Don't let them take your metal. Don't let them shake you out. Hold your ground. The empire is pushing back because it's losing. And when your opponent is desperate, that's when the advantage shifts. $375 is coming. The timeline is speeding up. The fundamentals are undeniable. Get your capital out of the paper market. Get it into physical silver. Act now.